Good morning. It's great to be with you again. I hope you're all doing very well. I've certainly got a few more gray hairs after April, but we've got some great slides and some very interesting charts today to help explain the chaos. And certainly April felt like some pretty serious chaos. And then we'll end off today with an example portfolio on using the Sygnia Life Plus funds. So let's jump straight into the month of April. And if you look at these returns, you'll be forgiven for not realizing that the NASDAQ 100 fell 23% from its February peak to its 4th April lows. Just amazing how the returns for April are so solid, despite all the underlying volatility and noise that we've seen. Mostly that's because of the blink or the pause of the tariffs that Trump put into place, and that helped markets bounce. And amazingly, many markets are at or even higher than their previous highs. Japan is at new highs. South Africa is at new highs. Europe is pretty much close to its previous highs. The only markets that didn't get back to its previous highs was the US. And in fact, the US has had its worst 100 days, first 100 days of president's for President Trump since Gerald Ford in 1974. And that was following Richard Nixon's resignation. So certainly nothing you really want to be compared to. So the US is down, and you can see there that for the month of April, even in Rand terms, and obviously the Rand did weaken a bit, the US market only returned 0.2%, basically flat. That's despite FANG stocks being up 8.3%. So the best performance for the month was from the FANG stocks. I'll talk more about them on the next slide. But gold also continuing to be a great place to hide, up 7.5%. Generally, just a solid month of returns. It really is quite amazing how resilient the markets are. And I'll talk to you more about it in our outlook, but I think the markets might be getting slightly ahead of themselves, considering that these tariffs are still in place and growth is going to slow. So looking at the top 5 fund performance for the month, you can see that nicely in first place, the FANG ETF and the FANG Unit Trust, up a very decent return for the month, 6 and 7%, just showing how these stocks, the Magnificent 7 stocks, are still exceptional, even when the US is struggling. And part of that is because they have global revenue streams, and as the dollar weakens, so their offshore revenues are translated into higher dollar returns, and that does give them some protection. The other part is that they are mostly service orientated, and services at the moment are exempt from any tariffs. So generally they are acting as defensive companies and doing quite well. But the US as a whole, obviously struggling a lot. And we continue to see more bad news coming out of the US this morning, with Ford and other auto manufacturers saying that things are looking pretty tough. Then in 3rd place and 4th place, we have Japan and Europe doing quite nicely. And this is as markets are rightly concerned about what's going on in the US and China, with the tariffs there still in place. And so they're looking for places to hide besides FANG stocks. And Japan and Europe both looking quite nice. And then in 5th place, the South African listed property stocks were up very nicely, 5% for the month. Moving over to 12 months, Berkshire Hathaway, the only US, besides FANG, it's one of 2 US funds in the top 5 over 12 months. Berkshire Hathaway having a phenomenal return of 31.2%. And that's just, again, showing the global nature of that fund or that company. A lot of global diversification, recently been moving into Japan. And as the dollar weakens, that helps their NAV quite nicely. Also a large amount of cash on their balance sheet. When markets fall, they are seen as defensive positions, so they, again, do quite well. Of course, over the weekend, we saw Warren Buffett announcing that he's stepping down as the CEO of Berkshire Hathaway, a momentous event after 60-odd years, with Greg Abel taking the helm as CEO in a few months' time. The share price is off a bit on that news, but it's generally seen as quite a smooth transition with Greg having been there, MD of non-insurance operations for quite some time. Then South African property still doing well, second place, 26%. FANG up there in fourth place. It was out of the top 5 last month, but popped back in after the good returns in April. And then South Africa continuing to do quite well over the 12-month period. I mean, decent 25% returns over 12 months, considering all the volatility is just fantastic. And that's partly due to China, that's partly due to commodity prices rallying, partly due to the base effects of the strong performance of financials and retailers when there was a lot of GNU optimism. That is obviously fading a bit, and I'll talk to you more about that GNU optimism when I get to the South African slides. But let's move on to the chart of the month, and of course it has to be Trump.
Who were jumping a little bit out of line. They were getting yippy, they were getting a little bit yippy, a little bit afraid, unlike these champions, because we have a big job to do. No other president would have done what I did. No other president.
I certainly agree that no other president would have done what he did. Or maybe Xi Jinping, but no other developed market president would have done what he did. Trump seems to think that is a good thing. I'm saying that for different reasons. But anyway, we had the Liberation Day tariffs on the 2nd of April that went into effect on the 9th of April, and 1 week later, 13 hours later after that implementation date, so 13 hours after 9 April implementation, Trump blinked and he decided to suspend the tariffs. Obviously, markets rallied very nicely from that, and I've shown you on the previous slide exactly how well those markets did rally. But the blink was a result of a few things, partly because the NASDAQ fell 23% from its peak, partly because the intraday lows on the 4th of April saw $10 trillion being wiped out on the equity market. But most importantly, it seems that Trump, and here exactly when he was talking about markets getting a little bit yippy and people getting a little bit afraid, he was talking about the bond market and investors' reaction to the bond market. And the bond market certainly did react. It had its biggest 3-day jump in terms of yields since 2001. I mean, that's a huge move. And it's good that Trump looked at the bond market, because the last person who didn't look at the bond market was Liz Truss, later known as Lettuce Liz, because she survived shorter than a lettuce does in a fridge. And so good that he did listen to the bond market, and good that he did blink, because the bond markets have been known to bring down governments. So it was all about the tariffs in April and all about the blink that happened as a result. But we're now in this world of tariffs and tariff uncertainty. So looking at exactly what happened in the market, yes, there were some technical excuses for why US bond yields spiked so much over those 3 days. But I think the stronger reason was because there were some very big sales of bonds from Japan. Both retail investors and institutional investors sold US bonds and bought European bonds. And similarly, that China's sovereign wealth fund sold US bonds and bought European bonds. And that's quite clear when you look on this chart on the right, which just shows in green, it's the yield difference between German 2-year bonds and US 2-year bonds, and then the euro-dollar exchange rate. And you can see there that in normal situations, the dollar-euro exchange rate follows those 2-year bond differentials very closely, because there is quite an easy arbitrage opportunity there. If one is higher than the other one, well, then you can hedge in the FX market and move from dollars to euros or vice versa, and that keeps those markets working quite efficiently. But what you can see here is this huge spread where that bond differential fell and the dollar weakened at the same time. And that was just a result of foreigners selling US bonds, selling the dollar as well. So this was just an outright switch and moving into euros. And the same thing was happening in the equity market. Foreigners were selling the S&P 500, again selling dollars, buying euros, and buying that European stocks. So a big move as a result of basically people selling America. We've got We've got some phenomenal moves that happened in April, and the White House's shifting stance and reliance on executive orders, which are only possible in emergency powers, and even then that's debatable, and that it bypasses Congress. All of that's undermined confidence in the US. And I think there can be some very, very serious long-term consequences for the US. And this chart shows how foreigners are just dumping the US as they're concerned about exactly what's going to happen. So what is going to happen? Well, where we stand today, Trump blinked. We only have the universal 10% tariff on all countries, excluding a few things like the autos and the cell phones, which I'll also talk a bit more about later. But generally, there's this 10% tariff on the rest of the world, except for China. And China, there's still up to 145% tariffs because China is not, well, it's basically the only country that didn't back down and agree to some sort of negotiation. Now, even if we halve that, let's just assume that we have the flat 10% tariff, and we have a 60% tariff on China. That still slows global GDP by 0.7% this year. Now, our base case scenario is not a recession. So, this is not a bad thing. Yes, growth slows, but not to recessionary levels. But the fact that European, South African, Japanese markets are at or above previous highs, I think is a bit of a disconnect. Plus, there's all this uncertainty about what's going to happen. Yes. On Friday last week, Trump came out to say that they have a deal, and it's a fantastic deal, and it's the best deal, and it's a great deal, but they can't tell us what the deal is or who the deal's with. So I'm sure they're telling the truth, but we haven't heard any details yet about the details, about these trade deals. There's some positive news potentially from Japan and Korea and India, but nothing out of the EU and nothing out of China, which are the two biggest trading partners for the US. And the EU has threatened strong countermeasures, which could include digital taxes on US tech giants. Basically, they're going to say they're going to tariff Netflix, and Europeans will have to pay double for their Netflix if they want to carry on, watching Netflix. So that is a concern. We have more than 50 countries that are now looking at these trade talks, but it's going to be very difficult to have any sort of consensus because the starting point doesn't make any sense. And the tariff approach that Trump used was described as a crime against economics. So things are certainly going to be tough. So best case scenario, growth slows 0.7%, and the markets can continue, but most likely not all 50 countries are going to be able to negotiate trades. Things are going to be slightly worse. We still don't have any certainty on what's happening with China and the US. And there's been a significant deterioration in confidence of global investors in the US. So that is definitely a big concern. Okay, so let's move on to
the level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth.
So Jeremy Powell telling it like it is, tariffs are worse than expected. That's not really a shock. The market said the same thing. Growth is going to be slower than expected. Inflation is going to be higher than expected. I think that summarized it nicely. Of course, Trump was not happy with that outlook, and there was a lot of uncertainty again when Trump threatened to fire Powell during the month of April, and markets fell once again. But then we had Blink 2.0 when Trump backtracked on his threats to fire Powell, which he then followed with some more attacks. But I think that's more likely to continue. It certainly is the more rational route. As long as Powell is in power and as long as Trump tells the world that Powell should be cutting rates, if there's any problems and the US moves into recession, Trump just goes, listen, I tried, wasn't my fault. I told everybody that Powell was making a mistake and he didn't listen to me. But if he fires Powell, and then the US goes into recession, well, then it's all his fault. So I think he's making a lot of noise and he will continue to make a lot of noise, but I think he's keeping Powell there as a scapegoat. The bottom line is that tariffs will lead to lower growth and higher inflation, which is not good for an economy. So we've entered the second quarter, now we're a month into the second quarter, with a very strange dichotomy. And we've got very strong growth coming out of the first quarter in 2025. We've got growth that was better than expected. In fact, we had GDP in the US out last week, although it looked negative, minus 0.3%. If you moved all the technical factors out, was actually very strong, 3% GDP growth out of the US in the first quarter. Not only that, but we saw core PCE inflation lower than expected. So looking back and looking at the backward-looking data, things are looking fantastic. We've got very strong growth. We've got inflation that's under control, and US markets should be at all-time highs. But that's looking backwards. Looking forwards, things are far, far more uncertain. The chart on the right shows the forward-looking expectations for global growth. And you can see there that the US, which is in blue, the growth has been downgraded by nearly 2% in 2025. Still positive. I think it's still about 1.5% net growth expected out of the US this year, but huge downgrade. And I think what's more significant is the fact if you compare that chart, that blue line, the downgrade in US growth is far more than the rest of the world. Latin America in green is probably pulled down a little bit more because of Mexico and its proximity to the US. But the rest of the world, very, very small impacts this year. So the question is, why is the US being impacted more by tariffs than the rest of the world? And you'd think that if Trump's doing it, he'd have some control and he can mitigate those factors. Well, it's two factors. One is that the reason that the markets rallied so strongly into the end of last year, and the reason we were overweight the US last year, which clearly we got wrong, was because the world is all going to be impacted by tariffs, maybe the US a bit more, but at the same time, the US was going to lower taxes and deregulate, and there were a lot of good factors that were balancing it. Now, this year, Trump hasn't mentioned lower taxes and he hasn't mentioned the deregulation, and there hasn't been the good news. There's just been the bad news about tariffs. And that hopefully will change over the next few months with less focus on tariffs and more focus on good news. But right now, the focus is on just the bad news. And tariffs are bad for the US. 2/3 of US manufacturers are importers. They don't make the goods completely in the US. They import all sorts of intermediate components, and they're all vulnerable to higher input costs. So these tariffs are very bad for US manufacturing. Supply chains take years to realign. So you can't just put tariffs on overnight and expect things to work. It takes 3 to 5 years for these supply chains to realign. In the interim, all those companies, if they survive, are going to face huge profit margin compression, as all the auto manufacturers have come out to say, and many other companies in the US. Not only that, it's not just tariffs, but we've also got other policies that have been put in place, like those for NVIDIA and AMD, where the US is restricting the markets that those companies can sell. And basically, at the moment, they can't sell their chips into China, and that has a huge impact on their revenue and their profitability. So it's partly tariffs, it's partly the restriction on who the US companies can sell to. The reciprocal is the same. US companies that sell into the rest of the world, we're seeing boycotts against those products, and that's going to hurt those companies as well. So generally, tariffs and these non-tariff barriers are impacting US companies, which then means those companies slow down or pause on hiring, and they slow down or pause on investment, which means that overall employment slows, investment slows, and even if we don't have tariffs, the whole US growth is just going to slow down, which is not a good thing. Not only that, but as Powell said, we've got concerns that some of the tariff costs will be passed on to consumers. Not all of them. Some consumers will trade down, some will substitute, some companies will impact their margins, but some of these tariffs will be passed on to consumers, which will keep inflation higher, certainly higher than the rest of the world. That means the Fed won't be able to cut as much as the rest of the world. So now you've got this double whammy. You've got, even though energy prices are falling, the dollar's weakening. So US consumers are facing energy prices that aren't falling as much for the rest of the world. US consumers are facing interest rates that aren't falling as much as the rest of the world. And that's all, bad for the US consumer. So things aren't looking that good. Now, we have cut our US exposure. We do still think that that there is upside to the US, so we aren't underweight the US completely when we have substantially cut our US exposure, but we still have slightly above benchmark on the US, and that's because the companies that are there we just think are really solid companies. But we'll watch this and see what's going to happen. There certainly could be a bit more good news coming out of the US in the short term as Trump walks back some of these tariffs. We may use that bounce to cut back further on the US, but for now we're keeping a small overweight to the US. Okay, so moving on to Blink 3.0. So the first blink was the tariffs. The second blink was trying to fire the Fed. And the third blink was against China. And here we have Treasury Secretary Scott Bessent saying that a trade war against China is unsustainable, and he expects it to de-escalate. China hasn't blinked, but the US certainly has against China. Not only that, but Trump removed Chinese tariffs on cell phones and other consumer electronics. So they've already scaled back on those 145% tariffs. So consumer electronics are only currently facing a 20% tariff from China, and we'll wait to see what happens. But clearly, this blink is not giving Trump any more negotiating power. And Beijing believes, rightly so, that they're in a very strong position. And that's why they haven't blinked. And they're probably going to have to rely, or we're going to have to, the world's going to have to wait for Trump to slowly, maybe, and quietly remove some of these tariffs going forward. So let's look at some of the reasons why I think that Trump will have to step back first, not China. Well, the first of the chart on the right there, you can see that China's net exports to the US have dropped significantly from a high of 9% of Chinese GDP down to 1.6% of GDP. Now, that's something that China can offset, not easily, but with fiscal stimulus, they can certainly make a big dent out of that 1.6%. And compared to the rest of the world, they are able to stimulate and protect through domestic consumption. So that's one point why China is not too concerned. The second is that China has a near monopoly on the source and the processing of most rare earth minerals, which are critical in the electronics sector, particularly for semiconductor chips. So they don't have to worry about, they can't just use tariffs, they can also use their monopoly in critical rare earth minerals to try and negotiate with Trump, which they're already doing. Thirdly, they can deploy non-tariff measures, such as blacklisting US companies, which they haven't started yet in a major way, but they could do, because the US has done this in a big way. And there are a lot of other factors. Chinese stocks have low exposure to overseas revenues. So while the S&P 500 is about 40% exposure to global revenues, Chinese stocks are about 15%. So if the rest of the world markets tank, China is reasonably cushioned compared to the rest of the world. And then things just get complicated because the world is hugely integrated. So over 1/3 of Chinese sales to the US are made from companies that are either completely owned or partially owned by US firms. So, 1/3 of the tariffs on China is going to hurt US firms. Then things just get more complicated. Chinese businesses have direct or indirect control of 70% of global supply chains. This is a massive point. You can't just turn off China overnight. 90% of laptops are still made in China, and a huge portion of cell phones, which is why Trump removed the tariffs on consumer electronics. So, and supply chains take years and years and years to readjust. So you just can't switch this off overnight. So what we might see happening, or what we are seeing happening already, is a huge jump in the number of companies in Malaysia, for example, who are offering whitewashing services. China can have their goods sent to Malaysia. They put in new packaging, slap on a new label, and suddenly your source of origin changes. Possibly you can look through this somehow if you're clever, but if it's done in enough places, it just becomes too difficult to catch everything. So we might see some things slip through, which will fortunately reduce the tariff impact. But the worst case scenario is that we end up with, two global economies, with China trading with the rest of the world, and already China is strengthening its ties with Europe and other economies to try and cut out the US. But if you have two parallel supply chains, that's not going to be good for profits. It's not going to be good for efficiencies, and definitely not going to be good for globalization. So that would hurt markets quite a lot. But China's already trading more with the global South than the US. So we might be heading for this dual global economy. I hope not. But if Trump doesn't back down, that's where we're heading. Now, China has expressed that they are open to negotiate with Trump. They haven't cut well, they cut a little bit of tariffs, but they haven't cut a lot of tariffs. They are open to negotiations, but some of the points that they're open to negotiation are very sticky. They want the US to address China's relationship with Taiwan, which is going to be very difficult to agree to. They also want the US to remove the sanctions they have on China, which is also quite political. And I think the big issue we have with these tariffs, and why it will lead to a slowdown in the world, is that when it comes to efficient global supply chains, that was all driven by companies. So it's free market economics. Companies in the US realize that they can manufacture something cheaper in China. They can have a call center cheaper in India. And as a result, Americans have the cheapest iPhone in the world by 30% to 50%. And those companies, US companies, still make the biggest profit in the world. So that's efficiencies, that's global dynamics. When it comes to tariffs, when it comes to the implementation of tariffs, they're not done by companies. They're not done by consumers. They're not done in the most efficient way. They're done by politicians. And politicians do it not for efficiency reasons or for fairness or for anything that would help profits or reduce inflation. It's done for politics. And that is the problem, is we're now seeing politics driving supply chains, politics driving profitability, politics influencing markets, and that is very difficult, because once you start, saying, well, the forecast for Apple's profits depend on whether China and the US can agree on what they're going to do about Taiwan, well, then, how are you supposed to forecast that? It's impossible. And so there's a huge amount of uncertainty that is now being introduced into the global supply chains and world markets. Now, I've spoken about this before. This is not something new. This has been happening since the great financial crisis. It's an extension of Brexit, Trump 1.0 and his global tariff wars, even the Russia-Ukraine war, and to some extent the Israel-Gaza war. What we're seeing is overpopulation. What we're seeing is global growth being its slowest over the last decade that it's been, and inequality rising to record highs, people being unhappy, populism moving into politics, or populist governments being voted in, or governments switching to more populist tactics to stay in power. And we've got this mesh of politics and economics, which basically means that capitalism becomes very blurred and starts to look like something else. Not exactly socialism or communism, because it's more complicated than that, but it's not free market, and that is the worst outcome you can have for markets. So, China, as a result of its economic and political power, looking more stable at the moment than the rest of the world. Now, emerging markets are also looking quite good, partly because China is looking good. Now, we haven't gone. We bought emerging markets. We bought quite a lot of emerging markets. We're still underweight relative to the ACWI, but very close to our ACWI benchmark. And emerging markets are looking strong, not just because China has done a lot of fiscal stimulus and they've changed a lot of policies to reform. But if you look at the chart on the right, you can see there that this is a long-term story of US exceptionalism causing the dollar to be too strong. So In the noughties, 2001 to the Great Financial Crisis, you can see there that the EM currency basket in blue strengthened. And it made sense because it strengthened because EM growth outperformed US GDP growth. Then through the teens, 2010 to 2020, you can see that the EM currencies weakened, and that made sense because EM growth was less than US growth. But over the last decade, the green line has pretty much moved horizontally. So EM growth has been in line with US growth. But EM currencies have weakened substantially. And it's not just EM currencies. The yen's weakened massively. The euro has been too weak. Everything has weakened relative to the dollar. On a purchasing power parity basis, the dollar has been up to 20% too strong. It's given up about half of that. It's probably 10% too strong, but it could still give up a bit more. It's quite debatable. There are a lot of factors that influence that, and we can talk about that in the outlook slide. But the bottom line is there is this cushion in emerging markets in terms of EM currencies, and that gap slowing. So not only is there a bit of cushion when it comes to EMs, but as US growth slows, so EM growth on a relative basis will pick up. So that means that even if that gap doesn't shrink, EM currencies will strengthen against the dollar because that green line will move up in terms of stronger relative growth out of EMs. Now, why are EMs? It's a bit of a chicken and egg. Why are EMs doing well? Well, it's partly because the US is slowing, but it's also partly because the dollar weakness actually helps EM growth because EMs fund a lot of their debt in dollars. And as that debt shrinks, suddenly they're paying less on their debt. So they get this automatic kicker in terms of their profitability. Then there are other factors. EMs like DMs ex-US are seeing falling inflation. And those central banks are able to cut rates if they need to, whereas the US can't. And so that lower policy rate will help EM growth where required. Then the big one, which impacts South Africa, and I'll talk more about this in the South African slide, but EMs are, not all EMs, but many EMs are supported by rising commodity prices. So we've got record high metal prices, falling oil prices, which is very good for Latin American EMs, very good for South African EMs, obviously not good for Middle Eastern EMs because they rely on oil, but generally EMs as a whole benefit from rising metal prices and falling oil prices. So our base case is still that the US doesn't go into recession this year. And if that's the case, if we stay in a sort of not quite risk on, but muddling risk on environment, then we should see that the relative growth and relative stability of EMs will lead to capital inflows and a stronger EM, which is why we have increased our exposure to EMs at the expense of US. Okay, moving on to South Africa. This is a fantastic photo of in-specie Jonas. I think he's looking great. I particularly love his chair. I wish I had an office chair like that. It's just an awesome chair. So the good news is that we've got a fantastic appointment. MJ has been appointed to, or as the special envoy to the US. Now, this is a very clever appointment because he can't be fired. He's not an ambassador. Trump can't fire him. He's there just to try and smooth the way for our ambassador and improve relationships in the US. So Sygnia's got a very special relationship with MJ. He did sit on our board, and we believe he is a fantastic appointment and can lead to some great things between South Africa and the US. And here you can see him saying, I'll do my best to promote a healthy working relationship between South Africa and the US. So that's good for medium-term relationship with the US, and the short-term things aren't looking great. And we've got our 30% tariffs. So what does this mean? Well, US exports from South Africa are about 4% of our GDP. US is the second biggest trading partner after China, and so this does impact us. We did have AGOA, or we have AGOA till September, but that's only 20% of our US exports, and these 30% tariffs completely wipe out AGOA, so it's not even worth looking at AGOA. The good news is that, like China, some of our exports, in fact, half of our exports, are critical for the US. So we have tariff exemptions on platinum, gold, chrome, copper, manganese, and aluminium. So basically, our resource sector and commodities are unaffected by the tariffs. Steel is hurt. So that is the one of the commodities and one of the resources that is not protected, but half of our exports aren't. Now, the remaining half of our exports are heavily weighted to autos and agricultural exports, particularly citrus. Citrus will be very hard hit unless we have some good negotiations that take place. The other factor is that obviously Trump has now walked back the auto tariffs. So possibly the auto tariffs aren't in play anymore, but assuming, the chart on the right assumed a 25% tariff adjustment on autos, or basically on a 51% basket. So it was before the auto tariffs walked back. And that has that's scenario 2. If you look at the right-hand side there, that's a 23 basis point decline in our GDP as a result of the tariffs. You might think that's nothing. For most countries, that is nothing. But when your growth is sitting at 1.5%, it is something. So it's certainly not great news. Then some other news coming out of South Africa. Our inflation continues to fall, which is great. It means that hopefully we can see some more rate cuts, which will be very, very good for our growth. Inflation came in below expected at 2.7% relative to expectation of 3%. So that's good. The counter side of that is the reason our inflation is so low, despite our currency weakness, is that growth is just very low, and there's no ability to pass on any inflation. So it's it's good news, but it's also bad news. Now, let's talk about the rand and actually tax revenues. We've got really good commodity prices. As I said, copper hit all-time highs. Oil prices are looking very, very, very low. And we had some surprising news out of OPEC, where they have once again increased production, and oil fell below $60 a barrel. So they basically, it's a race to the bottom. OPEC Plus have realized that many of the countries that are part of OPEC Plus are still producing, or were still producing, more than their tariffs. Sorry, more than their regulations allowed. So the big producers like Saudi Arabia are just saying, well, if everyone else is going to sell oil, we may as well play the volume game. And if we're getting it at lower prices, at least we get higher volumes, and we can still get our revenue that way. Now, I think break even on these oil production is about $50 a barrel. So this oil could even fall further as OPEC Plus fights for volume. That's very good for inflation and for the world. And it's very good for our terms of trade, because South Africa obviously imports oil while we export metals. So our terms of trade is looking phenomenal. And if you had to look at the rand on a terms of trade basis, the rand could be anywhere between 15 to the dollar and 16 to the dollar. So there could be a lot more rand strength based purely on what we're seeing in the commodity market and our terms of trade. Not only that, but strong commodities will help our revenue, tax revenue, and hopefully that'll help help Treasury raise further income. So why is the rand weak? Well, because we have huge concerns about the tariffs and huge concerns about trade wars, and we just don't know what's going to happen with global growth. So that's understandable. Until we get more certainty, I think there's going to be a lot more volatility. But if we do see things improve in terms of certainty for tariffs on South Africa and on the rest of the world, well, the rand has a lot of room to strengthen. But that's not our base case, unfortunately. We are actually busy reviewing our strategic asset allocation, and we're considering taking more offshore from a long-term perspective. Switching SA bonds into global bonds and switching SA equities into global equities. And some of that will be emerging markets, so it's more just diversification, but some of it is concerns that South Africa has some problems. So why do I say that? Well, the good news, again, is that the VAT increase was not put through. So we're now heading for budget 3.0. Like we had Trump 3.0 blink, South Africa is heading into budget 3.0. So why do we need a new budget? Well, by the 21st of May, we have to have some sort of balance to the budget. Having no VAT increase suddenly leaves a hole of 75 billion rand over the medium term. So where are we going to find 75 billion rand? Well, I think that we're going to take the easy option. Maybe you could call it the clever option, but the easy option, which is to fudge. We'll push up growth a little bit. We'll say there's going to be more from commodity prices being high. We'll say maybe a little bit more efficient tax collection, and we'll sell the family jewels. So last year, to make ends meet, we sold some of our gold reserves. I think we're going to sell a bit more this year because that's the only easy way of making that budget meet in the short term. So I think there are enough levers to pull so that by the 21st of May, we have a balanced budget. But that's the short term. By next year, we'll have sold the family jewels and we'll be facing a very, very difficult position of not being able to afford the social grants and the COVID grant, while not being able to afford the huge increase that we've seen in government wage bill, and not being able to increase any taxes because we've passed the Laffer curve, but we also can't take on any more debt because our debt to GDP is still not consolidating, and it's bad for our credit rating and bad for our cost of tax. So there really is no way out. The only way out in a year's time, so I think we're not going to have any bad news now, but in a year's time, the only way forward is hard decisions, cutting costs, whether it's the government wage bill or whether it's social grants. We need the political will. Again, we've got politics influencing markets. We need the political will to balance the books, and that's going to be very, very difficult because it's not an easy decision to cut social grants. It's not an easy decision to cut wage increases. Yeah, I think that not enough is going to be done because it's not easy. So hence our concern about South African markets. That said, that's a South African issue. And the good news is that EMs as a whole could do very nicely. We've got high commodity prices, we've got a weaker dollar, we've got markets looking to diversify. Just a little sale out of US is a massive buy into emerging markets. So we could see foreigners move back into South Africa, and we could actually see our markets do quite well. So again, it's a bit of a balance, and that's why we haven't made any changes yet, but we have to balance potential positive news in emerging markets against negative news out of South Africa. Maybe we just switch some SA into EMs, or maybe we switch SA into DMs ex-US. I don't know. We're waiting to watch to see what happens because it's so difficult to understand exactly what happens. But the bottom line, and I'll get to it in the outlook, is that we are cautious of the outlook. Okay, so let's move into positioning. So chart on the right shows that the IMF has downgraded their growth. So this is IMF's 2025 and 2026 growth outlook, comparing their January numbers this year to their April numbers. So just the change over the last quarter for their growth outlooks. And you can see there, quite a large decrease in growth for this year. So tariffs decreasing growth by 0.75%, but very little impact on growth for next year. So obviously, assuming that tariffs aren't put into place in any big way, just what's currently in place, and none of the threatened tariffs happen. Let's hope that's the case. We are very cautious about the middle of the year. So firstly, it's coincidentally is a good time to sell in May and go away. But the bigger concerns is we've had a huge front running of trade. So that first point there, accelerated shipments ahead of tariffs. So companies and consumers in the US have been very worried about tariffs and the cost of their imports. So what they've done is they've been building inventory ahead of the tariff increases. So at the corporate level, consumers have been buying new iPhones ahead of the price doubling at the consumer level. So growth has been very, very strong in the first quarter. And a lot of that growth has been stronger than it should have been because of this tariff front running. Now we move into the second quarter and third quarter of the year. Tariffs are in place, costs are going to go up, and companies are going to scale back, and consumers are going to scale back. Already, we're seeing this with shipper container bookings in April from the US to China, down 45% year on year. That's a huge amount. Now, some of that will again be whitewashing of shipments, so they'll be going from China via Malaysia to the US. But a lot of it is actually just a slowdown because of the front running. Some of it's also slowed down because growth is actually slowing in the US because we've had this ongoing uncertainty. And so corporates are not hiring, corporates are not investing, even consumers are saving a bit more and just being a bit more cautious. So we've got this uncertainty which weighs on sentiment, which weighs on spending, because everyone's waiting to see exactly what these tariffs mean. And the only thing worse than bad news is uncertainty, because bad news at least you can plan for, and you can even start spending because the bad news is out, but or making a plan. But uncertainty hurts everybody. So that's why we're more cautious. Again, there are some good points of why we're not going to see a recession this year. Very strong household balance sheets in the US, very strong momentum of growth in the world for Q1. We've also got more supportive fiscal policy coming out of the US. Trump is going to focus more on good news. Now, again, Trump he's got his midterm elections next year, so he can't afford. Well, in theory, he shouldn't put on draconian tariffs because his disapproval rating is already skyrocketed to 56%. So assuming that there's some rationality and assuming that Trump doesn't want to lose midterm elections, because if the Democrats take control of the House and the Senate, well, then Trump can't do much. He becomes a bit of a lame duck and he loses face. So hopefully he doesn't put on any draconian tariffs. And hopefully he focuses on the good news, and we'll see some US fiscal stimulus. We know that Germany is already planning 500 billion euros for infrastructure over the next decade, and China has announced just a plethora of stimulus factors that are going to come out and support the economy. So we do have fiscal stimulus that will help. And as I've mentioned before, falling energy prices are very good, and particularly good for Europe, because they've seen not only oil prices fall, but natural gas prices, despite the ongoing concerns about a war in Russia and Ukraine. Natural gas prices are down 30% this year. And so that helps Europe, particularly in terms of their lower costs, and Europe seeing interest rates being cut faster than the US. So Europe doing quite well in terms of their misery index compared to the US. So that's where we are. We've got this dichotomy. We've got things looking pretty good on the ground. If you look at even current expectations or current data, which is backward looking, but this massive amount of uncertainty going forward because the entire world outlook is based on negotiations for tariffs, which are based on one man, Trump, and what he decides to do. Now, that in itself is a terrifying factor, and that in itself is why we're seeing people sell the US and move out into the rest of the world. And that is why we have reduced our exposure to equities and remain cautious, because we do think that there's not only the slowdown that's going to happen because of tariff front running ending and because of hiring freeze and investment freeze, but this uncertainty is going to continue. Best case. Worst case is that we see more tariffs, and we're already today we're seeing Trump announce tariffs on pharmaceuticals, potential tariffs on pharmaceuticals, and potentially, and I don't even know how this works, tariffs on movies. So there's basically an announcement today that's coming out of the US, and I do think that as we go into the slow patch, there will be better buying opportunities ahead for many countries. Now, without being the two-handed economist, I do think that, as we saw with the FANG performance this month, that there will be some good buying opportunities coming up. Those FANG Magnificent Seven companies they've got fantastic moats, they're great companies. Berkshire Hathaway is another great US company, and many of the companies should be able to survive Trump. at least when we get to a point when the CEOs band together, like US universities have banded together. So I'm sure you've seen Trump's been attacking everybody, but one of the attacks is on a number of universities, and they've all agreed to band together to have a unified front against Trump and what Trump's trying to do. Companies in the US are not doing that. So when Amazon was called hostile for just trying to disclose what the tariff impact was on the prices, so you're buying a widget, the price is this, it's gone, the taxes that you're going to pay are that, and this is your final price. A bit like airline tickets, there's nothing too shocking. Amazon was called hostile by the White House, and they backtracked on that. So right now, US CEOs aren't standing together, but when they get to the point of standing together against Trump, well, then maybe there'll be we could see a better entry point into US markets. And I do believe those CEOs have the ability to do that. But for now, they're either whispering to each other or whispering on the sidelines and not being as brave as the university. So crazy month for April. Some huge volatility. We used that volatility we sold quite early, which worked well for the funds. At the bottom, we bought some Europe and some emerging markets. So we used the volatility very well to switch out of the US into Europe and emerging markets. We still do have a small overweight to the US. And we may use more volatility to switch out completely, or we may get back into the US depending on what market moves would happen. But overall, we've reduced our equity exposure about 5% year to date, and we think it's just better to be a bit cautious as we move into the middle of the year, as growth is slowing, as there's still daily updates about Trump, and as we just don't have any certainty of what's going to happen. So. Yeah, it's tough times ahead, I do believe, unfortunately. Okay, final slide. Talking about the Sygnia Plus funds. I mentioned to you last month that the two funds have been launched. So what I've got here is just an example portfolio, assuming you have a living annuity on the Sygnia platform and you want to get more global. And as I said, our SAA, we are trying to get more global. Even though I think the Rand could strengthen, because of positive emerging markets and because of positive commodity prices, I think diversifying away from South Africa is always a safe solution. You get a better Rand hedge, you get better diversification, and there are many benefits to having global exposure. So what I've done here is just assuming that you've got a portfolio that is half focused on local income, because you get fantastic yields from SA bonds and fantastic yield from SA credit, and assuming that all your growth assets, where you can, are global because of the diversification and better growth that you're seeing around the world. And the starting point is 50% income, local income, and 50% global growth. Now, that obviously will change depending on your risk. It will change depending on how much yield you need. So if you need more income, you will have maybe 70% income and 30% growth. If you don't need much income, maybe you'll have 70% growth and 30% income. And the other thing that you can see here is that because we have the 40% cap on global, the portfolio I've put together here has 40% global exposure and 10% in the Sygnia Transnational Equities Unit Trust. So that's our South African listed unit trust that invests in South Africa, JSE companies. It's seen as South African exposure, so it doesn't count for Reg 28 or for our global cap on the Manco limits. But the combined global revenue for those companies is 97% global. So it's got Richemont, it's got Naspers, it's got AngloGold, basically the companies that are purely selling to foreigners. So even as growth slows in South Africa, you're still getting your demand continues to grow. So that's 10% compared to 40% growth. And obviously, if you had higher global equities or global growth, you'd need more transnational because you capped it at 40. So let's see what I recommend as a one potential portfolio. So keeping the same split, 50% income, 50% growth, but now you can use the plus funds to get more global exposure. So what I've done is, if you look at the Sygnia MSCI World ETF, that's the second row under global growth, I have decreased that by 10% and switched that into the Sygnia Life MSCI World Plus. So what that means is you are getting the same underlying exposure, you're tracking the same index, but you've gone from tracking it in the ETF to slight outperformance, potential for outperformance because you're moving to the portable alpha, the Life Plus fund, which has a little bit more extra return because it takes on a bit of credit. So you're keeping the overall risk with 10% MSCI World, but you're switching it into plus. Now that frees up 10% exposure to other global funds, which are still capped at 40. So you can see here in that bottom line that 40% is still, the non-plus funds are still capped at 40 and are still sitting at 40. And I've decided to switch that 10%, 5% into Berkshire Hathaway and 5% into emerging markets. Now, that's partly because we have put a bit of exposure into emerging markets over the last month. And partly because I do think Berkshire Hathaway is a very, very defensive company and good for the outlook. And it's pulled back recently after the announcement of the new CEO. So, maybe it's a good opportunity to get in there, even though we are a bit cautious on the US. So you can see there that the exposure to EMs have gone from 5 to 10, and exposure from Berkshire Hathaway has gone from 5 to 10. But the overall global growth is still sitting at 50. Then I've also increased the global income by 5% by putting 5% dollar cash into the portfolio. And that's just it does reduce the income level because you're getting much lower yields on dollar cash, but it improves diversification. So this again becomes a risk reward decision. So the amount of global growth you want compared to the amount of local income depends on risk reward and how much yield you need. So it's probably driven primarily by your yield. But then within global growth, the amount of core MSCI World relative to satellites, such as Berkshire Hathaway and emerging markets, will depend on your risk appetite. Do you want more EMs and more Berkshire? It's a bit more risky, it's a bit away from the benchmark, or do you want less? And on the income side, if you're more worried about certainty and you're prepared to give up a bit of income, well, then you can get some dollar cash, which, although it's got a lower yield, does better when risk is off and the rand weakens. So it's all about balancing risk and reward, and it all depends on your own individual requirements. But this is just one example of how you can use the additional global exposure that the plus funds allow to get a more balanced portfolio, a more global portfolio, if you want more global. And I personally, right now, I do think that it's a good time to increase your global exposure. Again, that'll depend on how much equities or how much growth you want. You get more when you're worried about income. It's about stability of that income, and so it's better to have your income in local assets, majority. You can see that I've only got 5% out of 50 offshore, but you want the majority of your income assets local. Reduces volatility, and you're getting very high yields on enhanced income, and you're getting very high yields on the life income max up portfolio and our bonds. So good returns, low risk out of local assets. On the growth side, you want to have higher returns, and you want more diversification, and so you want more global. So again, your split between local and global is dependent not only on your risk appetite, but how much growth assets you want. So if you want more growth, then you will want more global, and you can use the plus fund, MSCI Plus fund, to get more of that exposure. Okay, that is a wrap for the presentation. Let's move on to Q&A. Okay, first question is from Merle, who says, Carl, do you think that selling, dumping of US stocks and the dollar and purchase of European stocks was planned, strategized? I discussed amongst foreign investors. Merle, that is a good question. So there's a lot of, I don't want to call it conspiracy theories, but there's a lot of potential strategies that might have happened. So, there's the potential that there's a deal between Trump and OPEC, which is why OPEC has increased oil production, because Trump knows that tariffs are going to increase inflation. So he wants interest rates to come down so that basically if a US consumer's got $2,000 to spend a month, yes, they may pay more for their food, for their pizza, but they'll pay less for their petrol, and they'll pay less on their bond if they can get the interest rates down. So maybe there's because it doesn't make sense why OPEC, well, it kind of makes sense because OPEC are fighting amongst themselves, but it is coincidental that this huge increase in OPEC plus production has all happened post-Trump. So maybe some foreign investors are talking together about switching into the EU. Definitely we're seeing governments talk about trade negotiations happening bilateral. So China is working closely with Germany, and China's working closely with France, and China's even working more closely with South Africa as everyone tries to find trade routes that avoid the US. Whether they are working together to agree to sell US treasuries, possibly. I mean, that's definitely one route. Again, it's a bit risky because those Japan and Europe have agreed not to put on any they've not retaliated. Definitely one route that Japan could retaliate, and Europe to a lesser extent is to sell US treasuries. So possibly they working on this, but that's a retaliation that might lead to more lead to a China kind of outcome. And I don't think Europe or Japan want a China outcome yet. I think they're prepared to negotiate. So I don't think so. John says, hi Kyle, how does SA property and SA equity gain 25% year to date when all the news and forecasts of SA large negative? Will this growth continue? John, so great question. So what we've seen over the last year, three things. Firstly, we had the GNU, which pushed up SA Inc., which included SA Property, SA Retailers, SA Banks. That re-rating hasn't derated yet. Then we had the Chinese tech rally, and that pushed up Naspers and Process. And then finally, we had the resource rally, which just come recently, and that's pushed up, well, it was a commodity rally, which pushed up resources. So we've had all three sectors. We've had property and financials, we've had industrials, and we've had resources all rally massively on three different sets of news. And well, I suppose the GNU was SA specific, but all of them were despite SA. Now, the only good news, which was the GNU, is sort of reversing, and we've got the China, while it's still looking good, there is the risk of tariffs, which could pull down both the commodity leg and the Naspers tech leg. So there's a lot of uncertainty, and I expect weakness in South Africa until there's more certainty about how China and the US will negotiate an outcome. Mervyn says the Sygnia MSCI World ETF is doing about 2% better than the Sygnia iTrix S&P 1200 ESG over the last year. Would you consider switching? So Mervyn, the biggest difference so obviously the iTrix 1200 ESG has a few stock differences because of that ESG overlay, but it's very small. The biggest difference is that it has a 5% exposure to EMs. So to the extent that you think EMs will outperform the rest of the world, then the S&P 1200 should outperform MSCI World. If you think EMs are going to underperform, well, then MSCI World should outperform. So it depends on that exposure. We have, as I said, increased our exposure to EMs. So possibly it's a good time to be in the S&P 1200 ESG. Paul says, after the plus funds, so are the plus funds now available? Replies from admin denies the funds are available. Paul, the plus funds are definitely available. They are on the website. I did check that, so please have a look. Yeah, I got the email address wrong last time. Apologies. It's admin@sygnia.fss.co.za. So was it admin@sfs.sygnia.co.za? And those funds are definitely on the website. Then Anonymous says, are you concerned about the effect of SA politics on equity markets? Yes, I am. I have explained that in the SA section. I do worry that basically we aren't getting the reforms we need. I mean, I think that the National Treasury is doing a fantastic job on the SOEs. They're definitely only handing out as much money as is required only when certain goalposts are met. So certainly, I think the SOEs are in much better hands than they have been over the last decade. But we need that same, the National Treasury can't manage the entire country, and we need that same focus applied to the other sectors, to the healthcare department, to the education department, to the defense department. They all need the same scrutiny and the same oversight that SOEs are doing to keep costs down and allow us to balance the books, but we're not seeing that just yet. Leighton says that it's been a significant growth in listed property. Can you talk to that, please? Leighton, so South African property has done well partly on the GNU and partly because it's a very, very concentrated index with a couple of stocks that make up nearly half of the index. And those top stocks have a very big exposure to Europe. And Europe right now is doing well because interest rates are being lowered. So you're seeing a bit of a European property exposure pushing up our South African property stocks. And also some of the GNU benefits are still in there, and interest rates are coming down. And as interest rates come down, it does. South African listed property stocks are highly geared, so as they come down, well, that feeds through to a much better upside on listed property. Then question from Brian. He says, Kyle, where's your money invested? Is your holdings public? Brian, I've been very open to say that 100% of my retirement savings are in the Skeleton Balance 70 fund. I'm a big fan of that fund. At 35 basis points, you're getting exposure to everything. About 40% offshore. You're getting exposure to all our themes. You're getting exposure to our tactical asset allocation, our strategic asset allocation, and I think that is a great place to be in the long term. So obviously, the biggest impact you have on which fund you should be invested in is your time horizon, and if you 7 years or further out from retirement, then you need to be maximum equities, and that's because there are two major risks in life. There's the risk that you lose your money overnight. That's capital risk, and that's the risk you feel. That's the risk that keeps you up at night. But the stealth risk, and I think the most important risk if you're a long-term investor, is inflation risk. And that's the boiling frog scenario, because you don't feel it until you get to retirement and suddenly you've got your money. It didn't lose anything, but it can only buy a quarter of what it could have bought you 10 years ago. So investing in equities controls inflation risk, or the boiling frog risk. And over 7 years plus, you need to manage that risk, even if it feels uncomfortable, because you could lose capital in the short term. So you need to stay invested through volatility. And the Skeleton Balance 70 is our highest equity regulation 28 fund. Baron said, is Sasol a buy at these levels? Baron, that's a great question. I don't focus on South African stocks. I know I focus mostly on the global stocks. So I can't give you a detailed answer on Sasol. I'm amazed by how cheap it is, but then the oil price is incredibly cheap and is obviously geared very much to oil price. And there have been some own goals that Sasol has made. Yeah, I'm amazed by how cheap it is, but I unfortunately can't give you much more input than that it's cheap, probably for a reason. Kestel says the fourth industrial revolution funds have lagged the FANG. What are the prospects perhaps going forward? So the fourth industrial revolution fund is effectively invested in our version, because we do make some differences in the index, but it's invested in the Sygnia version of the NASDAQ 100. So very much a more diversified tech exposure, and we do cap some of those exposures at 6%. So it gives you more exposure to not just large cap tech, but to mid cap tech, and that compares to the FANG, which is basically 10 stocks. So if you want mega cap stocks, you go for FANG. If you want more mid cap stocks, you go for the Fourth Industrial. So right now, Fourth Industrial is underperforming FANG for two reasons. One, FANG's got more global exposure in terms of their revenue. So Google and Netflix have a very, very global reach, whereas some of the mid cap stocks in the US don't. And tariffs are expected to hurt US focused companies more than the globally diversified companies. So FANG is outperforming, or US large caps and FANG stocks are outperforming US mid caps because of that global exposure and the fact that they are more insulated from tariffs. As if Trump walks back those tariff statements, then Fourth Industrial should outperform FANG. Of course, if things get worse and Trump carries on announcing new tariffs every day, like he did today with pharmaceutical updates and on the weekend about movies, well, then FANG might continue to outperform in the US. It also depends on, I think, quite important one is buying power, moats. So this is where it's something that Berkshire Hathaway has a natural inclination to do. Warren Buffett's theory has always been, they bought See's Candy. Why See's Candy? Because it has a very high ROE, so that when costs due to tariffs go up, your margins shrink from 30% to 32%. It's a minor impact. So that's quality stocks, which again, most of the FANG are quality, whereas some of the other industrial stocks have a very low margins. And Amazon is actually one of these. And there, if your margin is 4% and suddenly you lose 2%, a 4% margin going to 2% because of higher tariffs, or your profits halve. So it's not only about global capacity and services versus manufacturing. It's also about your ROE. So quality companies like Berkshire, which have been resilient, will continue to be more resilient, and the FANG generally do have higher margins than non-FANG stocks in the US, which makes them more protected against that margin influence. Alan says the income maximizer fund has withstood the tariff war very well. It has, Alan. Thank you very, very much for that comment. Yes, that fund it tries to harness the best of South African bonds and South African income. And it was very over South African bonds when South African bonds were super cheap and they had really high yields compared to income. But we have subsequently switched into SA income, which has given them some protection against the bond volatility as those bond yields and income yields became closer. Now, unfortunately, if bond yields carry on dropping, or interest rate yields carry on dropping, so because inflation is low, and if those yields drop further, we might have to switch back into bonds to carry on maximizing that income, which will obviously add a bit more volatility on, but right now we haven't had to do that yet. Monique says, thanks, Kyle. Pleasure. Your health innovation fund hasn't done particularly well. What's your view for keeping it long term? Monique, you're spot on. The health innovation hasn't done well. That's predominantly because of the health sector. So it's 95% exposed to the broad healthcare sector, which hasn't done well. It's also got specific allocations to the big semaglutide stocks, which also haven't done well. I continue to believe that long term, there's structural tailwinds for the healthcare sector, and that's because the world is slowing. GDP is slowing, and we've got overpopulation. We've got a shrinking pie feeding more people, which means there's going to be toothpaste sales are going to be fighting over a shrinking pie. Even Netflix sales are going to be fighting over a shrinking pie. But pharmaceuticals and healthcare companies are going to see a growing pie because people are getting older, people are living longer, and there are more and more innovative products coming through to extend our life. Now, it's very sad to say, that while our longevity has been increased substantially over the last 2 decades, it hasn't been done. Our health outlook hasn't. So the average US American lives their last 12 years under a serious illness, and whether that's diabetes or cardiovascular or mental illness like dementia, it's 12 years that people's lives have been extended in an unhealthy way. So obviously we all want to extend healthy living. That's primarily what you want to do. It's unfortunately not in the pharmaceutical or healthcare industry's benefit to do that. So I'm a bit skeptical here. You know, maybe you can take that with a pinch of salt. But as we live longer, as there are more drugs that extend our lifespan, if not our health span, it means that the revenue demand in the healthcare sector is going to carry on growing even as everything else slows. So yes, there's some short-term issues with the healthcare sector. It hasn't done as well, mostly because the semaglutide stocks got too expensive, and there's been some negative press about them coming out of Trump, also coming out of Europe. But they're also, I think, looking far more reasonably priced right now. You know, we haven't bought back in, but we're definitely looking at that quite closely, and we discuss it regularly whether we should buy in back into healthcare. Serena, to answer your question, yes, we do see the healthcare as defensive, because as growth slows, you can cut back on your Netflix. You know, maybe you've got 4 streaming providers and you decide to cut Hulu and hold on to Prime and Apple and Netflix. And maybe you decide not to go out to restaurants as often. And maybe you downgrade from luxury goods to a cheaper face cream. You know, there are lots of things that you can substitute when it comes to tariffs. Healthcare is not as easily substituted. If you're sick, you're sick. I suppose you can wait a little bit longer before you see a doctor, before you go on medication, but that's, generally, unfortunately, healthcare is something that we have to have. As it is, most of us only go to doctors when we have to. Diane says, thanks very much. Pleasure, Diane. And it looks like that is the last question. So thank you very much, everybody. It's been awesome speaking to you once again. And thank you for your time, and thank you for joining, and thank you for your questions. Let's hope for a better May, even though we are moving into a seasonally weak 4 or 5 months. And we'll see you all next month. Take care.